Hello, this is Leroy Meadows, and welcome to this session. In this session, we're going to be working exercise 13-22 out of the chapter 13, Pricing Decisions and Cost Management. And this exercise is at the end of the chapter, exercise 13-22. So let's go ahead and take a look at the question. Jason Brady is a managing partner of a business that has just finished building a 60-room motel. Brady anticipates that he will rent these rooms for 15,000 nights next year, or we're going to call this 15,000 room nights. All rooms are similar and will rent for the same price. Brady estimates the following operating costs for next year. Variable operating costs will be $3 per room night, and then our fixed costs in total between salaries and wages, maintenance of building and pool, and other operating and administrative costs of $190,000. So our total fixed costs are going to be $405,000. Now the capital invested in the motel is $1,500,000. The partnership's target return on investment is 20%. Brady expects demand for rooms to be uniform throughout the year. He plans to price the rooms at full cost plus a markup on full cost to earn the target return on investment. So the first question is, what price should Brady charge for a room night? What is the markup as a percentage of the full cost of a room night? So first of all, if we remember the cost plus pricing system, we need to get our full cost plus add the desired markup. So let's take a look at the desired markup first, and then so we can get our target contribution margin. So operating income is what? 20% of the investment made. So the investment was what? Let's see here. What did it say? 1,500,000. And 20% of that is 300,000. So that's the amount of profit that we want to have. So that's our desired operating income. What are my total fixed costs? My total fixed costs are $405,000. So my target contribution margin is going to have to be what? Because remember, contribution margin minus fixed costs gives us our desired operating income. Here, we're working backwards to get to our contribution margin. So to figure out our contribution margin, desired operating income plus total fixed costs, and that is how much? Well, that is going to be $705,000. So on a per night basis or a per room basis, how much is that? Well, $705,000 total contribution margin divided by the number of room nights we have or that we're expecting, which is 15,000. So on a per room basis, I want to have $47 of contribution margin per night or per room per night. Now we figure out our variable costs. And what are our variable costs? We are told that our variable costs are what? Here, $3 per room night. So how much is that? So my total selling price then should be what? $50. So now, and what I really did was took the contribution margin income statement in this first section here, and I flipped it around. If we look at it, what is our normal breakdown? Our normal breakdown is sales revenue less variable cost equals contribution margin less fixed costs equals operating income. So what I did was I just really flipped it on its head, and I worked my way backwards from operating income all the way back up to what I needed to be charging on a per night, what I needed to be charging, what was my sales price per night. So now let's take a look at the full cost per room. We already know our operating income and everything, but now let's look at the total full cost per room. Well, I already know from the problem that my variable costs are $3 per room And how much are my fixed costs per room? Well, we're going to take my total fixed costs of $405,000 and get what? And divide that, we're going to divide that by 15,000 room nights. So 405,000 divided by 15,000 room nights. And my fixed costs are going to be what? $27. So what is the full cost per room? The full cost per room is going to be my variable cost per room plus my fixed cost per room, and that's going to give me $30. So now I have to figure out my markup per room. So remember, in cost-based pricing, we take our cost plus the markup equals what? Our sales price. And this is a generic, so $30 and going to be what? $50 my sales price. And so what is my markup? My markup is going to be what? $20. So now we're asked, what is the markup as a percentage of the full cost of a room per night? So what is my markup as a percentage of my cost? So I'm going to simply take my $20 and divide that by the full cost, because that's what I want to get the markup as a percentage of. The markup is a percentage of my full cost, which is $30. So my markup percent is going to be what? 66.7%. So 66.7%. And let's put that as percent of full cost equals 66.7%. Now, let's do a little sensitivity analysis here. Brady's market research in requirement 2, Brady's market research indicates that if the price of a room night determined in requirement 1, the price of a room night, which was $50, is reduced by 10%, the expected number of room nights Brady could rent would increase by 10%. Should Brady reduce prices by 10% and show your calculations? Okay, so let's take a look here. And what is the new price of the room? Well, it's going to be what? 10% or 90% of what we're already charging. So if we're taking off 10% here of room night, so my new cost per room is going to be $45. What is the new number of rooms to be rented? Well, we're told that if we lower our price, we would rent more rooms. So if I have more rooms, how many rooms am I going to, they're going to be rented? How many room nights am I going to have? Well, I expect to have, I have, based on my original analysis, 15,000 rooms. That's what the problem told us. But if I expect an increase of 10%, I'm going to have 16,500 room nights. So 16,500. Now, let's take a look here. And what is my new contribution margin per room? Well, my contribution margin per room was what? $47. If I'm lowering my sales price, but my variable cost per room is going to be the same, then I am going to that sales price decrease is going to be passed directly to the contribution margin per room night. So instead of having $47 per room night, I'm going to have a new contribution margin of $42. Now, how does that translate to operating income or my total contribution margin? Well, my total contribution margin is simply going to be what? Contribution margin per room of $42 times 16,500. because that's the new number of room nights. And in this case, my total contribution margin, if I undertake that lowering of price, will be $693,000. Should I reduce the price by $10,000? Well, let's compare our new total contribution margin in the sensitivity analysis here to what I'm already charging and getting. My total contribution right now, my total contribution margin is $705,000. If I undertake the change, my contribution margin is going to decrease to $693,000. So I'm going to go from $705,000 to $693,000. So by lowering the price, I'm going to I'm going to get more activity, but my total contribution margin is going to decrease by $12,000. So should I undertake this change in this situation? No, I should not. Maybe if the number of room nights actually increased more, then I might want to go ahead and consider it and rework these numbers to see how many. Let's see if 17,000 room nights. Let's say if we undertook this and we did some more research and 17,000 room nights would work. And we're going to get 17,000 room nights. Then if this is going to be what? 693,000 equals this times this. Then let's say I get another 500 room nights, and so instead of 16,500, now I can actually get 17,000 room nights. Then my total contribution margin will change and will increase from what I'm doing now. So sometimes lowering the price will provide additional demand because it is price elastic, but the way the demand is increasing will determine whether we should do that or not. If we charge, if we increase from 15,000 to 17,000 rooms nights a year, then we should. But if we're only doing 16,500, then our operating income decreases, and we don't want to do that. So this is where price sensitivity, computing the full cost per room, getting our desired return on investment, this is where a lot in the contribution margin and stuff really makes a difference here. So and I'm just going to fill these in for us, just so we have this here and have this filled in correctly. So anyway, so this is where we get a sensitivity analysis here, combining with a lot of the information we've already learned. So as you can see, a lot of this stuff will come together, and this is how we can make decisions. We've learned a lot of principles about job costing. We're getting ready to do process costing in the next chapter. We've done activity-based costing. We've done budgeting and so forth, variance analysis. We've done a lot of things. Now we're in CVP analysis, sensitivity analysis. Now we're pulling all that stuff together to understand how we make decisions in the short term, which was the focus of the last chapter, the previous chapter, and then in the long term here in this chapter. So again, this is Leroy Meadows. I want to thank you for joining me. Have a good day.